Welcome to Market Call. Thanks for joining us today. I'm Morella Fernandez. Peter Hodson with us on the show. He's Chief Investment Officer and President, I2I Capital Management. He'll be taking your questions on North American small and mid caps. Here's how to reach us. 1-855-326-6266 if you'd like to call in. You can also email your questions in marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
Thank you.
Let's talk a little bit about the intraday high we're seeing on the TSX today. Record closes again. Is this coming, you think, from the Bank of Canada and Fed rate cuts?
Yeah, absolutely. I mean, investors have a lot of money on the sidelines, and they've been kind of waiting for a buy signal. And it's quite ironic because a lot of people wait, oh, it's all up, now I'll buy. But it really does work that way in terms of psychology. You've got the market going up, psychology, people are confident. You've got interest rates going down, so the alternatives, GICs, et cetera, are not looking so good. So it really starts sort of a slow wave of money coming back into the market. That usually continues until something goes wrong. And of course, you never know what's going to happen, and there's always sort of a black swan event that could happen. But right now, the confidence and the interest rate movements are really positive for equities in general.
Okay, small caps have not been getting a lot of love so far this year. Have you seen any signs of that changing?
Well, yesterday was great. I mean, we've had some really big moves. We're starting to see some merger and acquisition activity. But it really, that confidence that I was talking about, it has to last for a period of time before people say, okay, now it's time to buy the small companies. Yes, they will move, they will be volatile, but I think in the past 3 years we've had perhaps 4 or 5 false starts to a small cap rally, and everyone's been kind of, sorry, not this time, you're going back down. So
what triggers a false start in that capacity?
Well, it's usually, so obviously in April with the Liberation Day, that sort of scared everybody. Anytime inflation picks up, small caps kind of, they get a hiccup because they're quite sensitive to inflation and rates and things like that. But it's hard to say. You can't say this is going to cause a small cap rally. There's sort of no one indicator sign. It just kind of slowly builds. And then just like the regular market, investors get more confident, and then they're willing to take more risks. And as a fund manager, as small caps and mid caps, it's kind of annoying actually, because everyone talks about risks of small caps, and what they really mean is price volatility. But there are lots of small caps out there that are sitting on hundreds of millions of dollars of cash, and their fundamental risk is not that big. But their stocks go like this, and everyone says, oh, it's risky, it's risky, it's risky. But some of them are much less risky than a large cap that's sitting on hundreds of billions of dollars of debt that could get hit in interest rates if they move up.
And they're still very volatile.
Exactly.
Is money flowing into certain small cap sectors specifically, or kind of across the board?
In Canada, the golds have been, the small cap golds are up 60, 70%. It's just ridiculous in terms of how well they've done. We're starting to see some industrials, and we're starting to see small caps transition into big caps. So Celestica would be the best example. I mean, it was a dopey little company 5 years ago, and now it's a $30 billion company. So that's what really small cap investors want to see. They want to see that transition into big caps. Aritzia is another one. 2 years ago, everybody hated it. They had inventory problems. Now the stock's up 60 or 70% on the year. So we are starting to see some sectors. But then, of course, we're not into the micro cap, the speculative stuff. There are some pockets of isolated moves, but in general, people are still gravitating towards $2 or $3 billion companies, not $500 million companies.
Okay. We are going to take a quick break. We're going to line up some phone calls for Peter Hodson, I2I Capital Management. He's taking your questions today on North American small and mid caps. Here is the number to reach us, as well as the email address. We're back on the line. Welcome back to Market Call. We're going to start with an email from Jamie, who says, is Monday.com a buy? Monday.com, I had to look up software solutions. What kind of software solutions
so
do
they offer software solutions that help other companies coordinate all their various functions, payroll, accounting, things like that, inventory. So it's kind of a generalized software as a service type of company. And so the problem with Monday is earlier in their last quarter report, they basically said, you know what, our small to medium-sized businesses are not buying as much as we expected. So it's sort of a general economic comment, but it also kind of ties into AI a little bit. There's a lot of companies that are looking at AI and saying, AI can do this. And it's a situation where if you're a customer, you now have a buy or build scenario. And a lot of companies, they're not actually building their own yet, but they're saying, hey, maybe we could build our own solutions with AI. And so that's really hurt Monday. The stock took a big hit. It's not a bad company, really, but it's now 52 times earnings. It's got negative momentum. And you're going into tax loss selling, near year end. And so I just don't see it doing a whole lot until that kind of solution is improved or their business prospects improved with actual results.
This is a company out of Israel?
Yes.
Okay.
Yeah.
And I'm wondering if you stand where others are standing that software might get eaten up by the AI trend.
We don't think it's going to get eaten, but it's certainly a lot of some software companies need to adapt. And so whether you go and buy, make an acquisition to make yourself more competitive, or you buy a lot of smart developers and say, you know what, we've got our own AI solution. So I think there's going to be a lot of spending, and there's going to be a lot of angst and investor uncertainty, and sentiment may shift as it's seen. So you might see a multiple contraction for sure. But I don't think it's a situation where AI is going to come in and just totally destroy companies. Some will suffer, some will adapt, and some will still prosper.
Okay, let's get to the next phone call then from John, who's in London, Ontario. Hi, John.
Hello, Peter.
Hi.
I own a few small caps. Two have done well, in particular Zedcor, the security towers, and Kraken, Undersea robotics. So tell me about Kraken. It's done very well so far. I have a small position. Is it time to add to that position for about a 2 to 3 year hold? Thanks very much, Peter.
Sure, absolutely. We like it quite a lot. I would suggest a longer term hold than 2 or 3 years because it's still a relatively small company. But they do batteries, they do sonar, they've got a big military application. And one of their issues was their products are very good. They're very robust products, their customers like them. But it was a tiny company. And so if you're a big defense contractor or you're a big customer, you say, okay, here's a $300 million company. I'm a little uncertain about committing myself to this company for long term. So they went out and they raised more than $100 million to kind of shore up their balance sheet. They haven't spent it yet, but it's a really good sign for future business. And they've got lots of contracts. Their contract backlog is growing. And some of their existing customers have won new contracts, but they haven't translated that to Kraken's business yet. So the visibility is getting better. The market cap's now over $1 billion. And at that level in Canada, more investors come in and say, you know what, this is a pretty interesting company, and now I can buy enough shares to make it worthwhile. So,
okay, and I should ask, where do you go from small cap to mid cap? What is the range?
Yeah, I mean, a lot of people have different definitions, but generally under $1 billion, I would call a small cap, and $1 billion to $5 billion is mid cap. The U.S. is different because it's a much bigger market, so you can change those numbers a little bit.
Got it. Okay, let's go back to the phone lines. Terry on the line in Edmonton with a question. Hi, Terry.
Good day. My question's on MDA Space. Do you own it? Would you have it as a buy? And it took quite a fall there. So thanks for taking my question.
Sure. So I've got another company called 5i Research, and we don't own Canadian stocks, and our fund is just U.S. stocks. But MDA, I think, is viable right now. So they took a very big hit.
On the EchoStar.
Yes. And people were saying, okay, well, this obviously is a big hit to the company. It's a big blow to their future revenue and their earnings. But if you look behind the scenes, it had nothing to do with MDA. EchoStar was completely changing their business. They're selling spectrum. They're going to have $24 billion in cash. So it's an entirely different company. That contract was only signed in August, and they had the right to cancel it if there was a business condition change. So it's nothing to do with MBA. They now have the capacity to get another contract. The only trouble is these contracts, they don't come around every day. But the capacity is there, and they've done a great job with all their other contracts. So
and they've got a backlog, right?
They really do.
They do have a long backlog.
The revenue visibility is quite intense there. And so it's just a matter of time before that capacity is filled up, and everyone might like it again. And
sure, but investors seem to be punishing them a little bit for, as you mentioned, something that was beyond their doing, and also the fact that they haven't put any money into that work yet, so it's really not costing them anything.
No, exactly. And any money that they get back on a canceled contract, they get it back from the customer. So certainly it was a negative event. We can't deny that. But in terms of the stock reaction, we think was far overdone.
Okay, let's go to Chris on the line in Victoria, BC. Hi, Chris.
Oh, good morning, Marla. Thank you for taking my call. If I could please have the guest's opinion on Lululemon. I'm down about 18% on the stock. I bought it essentially as a right before the earnings and at a full 5%, portfolio weight. And I'm wondering if it's worth hanging on to or if I should cut my losses and sell. Thank you so much.
Thank you for that question. We've had a few queries about Lululemon, which has dropped very dramatically and hasn't seemed to be able to bounce off a bottom yet. What are you seeing here?
It's been dramatic is the right word. I mean, I remember going to the Lululemon IPO, I don't know how many years ago. I'm getting old. And, obviously they had huge success. And no one could figure out how they could have such high sales per square foot. Like, it was the best in the world. But of course, success attracts competition. Mm-hmm. And so I think you've got a situation now where Nike, Under Armour, they're starting to attack a lot of their products, but at the same time, they're having their own internal issues as well. So it's kind of a double combination of negativity. And then, of course, the stock's at a 5 or 6 year low, and everybody hates it. But I really would not count this company out. They took a brand, they created a market, and their customers love them. And so it's just a matter of getting back on track and trying to reestablish their dominance in certain areas. So certainly it's hard to catch a fallen knife, but at the current valuation, I think it's pretty interesting, but you probably need 3 or 5 years here to get this turned around.
Not that long of a
But it's one
timeline.
of those situations where if they turn it around, I mean, the stock could do very, very well. So I would maybe accumulate it slowly into any decline and remember a long-term thesis here, because it's been just a horrible period of news for the poor company. But all it takes is a little bit of good news, and I think it shifts around.
Okay, one other caveat to that. Post-COVID, it was yoga wear to work, right?
Yeah.
But that trend seems to be also moving away, which is not going to be good for a company like Lululemon.
Yeah, certainly the work from home was good for them. But again, this is not their first business cycle. They've been around for a very long time. And until recently, they've had nothing but success. So this is a slump. I don't know if they're going to stay in the slump or get out of the slump, but based on their history, I think they've got a better chance of getting out of it.
Okay, we are going to take another break. We'll line up more phone calls for Peter. He's going to take your questions on North American small and mid caps. Back in a moment. Welcome back. Peter Hodson with us today to take your questions. We have a question from John, who's on the line in Milford, Ontario. Hi, John.
Peter, I would like your thoughts on Bird Construction going forward. I bought it about 3 weeks ago. It was down a fair bit that day, and I see they bought a dredging company. Could you give me your thoughts about this company going forward? Thank you very much.
Okay.
Bye.
Sure. It's a relatively small company in the engineering construction space. And,
Okay.
one of their issues is they, every once in a while, they take a fixed price contract and then they lose money on it if there's cost overruns. So that is a risk, and that keeps the valuation low. The sector should have some growth with infrastructure spending that's planned.
Well, I talked to the Bird CEO, and he said exactly that. This is going to be a big bonus for them.
Absolutely. And so, the trends are good. They've had some issues, and again, they have to have a little bit more consistency in terms of their execution and meeting estimates. But honestly, that's not that hard to do. You just have to kind of lowball your numbers, and then you succeed. So, I would give it okay marks. We prefer the larger companies like WSP and Stantec in terms of safety, and especially because we don't know which way the economy is going to go over the next couple of years. And Bird's a relatively small company that's had some issues, and so if there is a hiccup or if there's a change in economic direction, investors will probably be quick to sell it or at least not to buy it. So,
Out of the construction companies, one of the problems Bird was having early on, and their earnings were reported, they were stalled, right? People were putting off their projects because of the climate. Yeah. Were the larger companies seeing that as well?
Yeah, a little bit, but then they have a bigger backlog, and some of them have a much more global operation, so they're not worried about tariffs. They've got other international divisions that can take care of things. But absolutely, it's a very economically sensitive business if you're building a $60 million plant or whatever the contract is. And that, again, it goes back to confidence. So you need the confidence. Interest rates will help that for sure. And, if the energy sector can actually get going, that would be helpful as well.
And the Build Canada.
Yeah.
Okay, let's go back to the phone lines. Rose on the line from Cambridge, Ontario. Hi, Rose.
Hi, Peter. It's nice of you to come on.
Thank you.
I'd like to ask you about Russell Metals. One of the previous market call investors recommended Russell Metals because he thought it would benefit from the build out of Canada's infrastructure, and it was kind of a safer bet on materials for all the projects. It's not moving at all. I keep watching it, and I'm just maybe the catalyst is in the future, and maybe I should be buying now. What do you think of this company?
Sure. Basically, I would say, first off, boring is not necessarily bad. If it's not doing anything, that can actually be good. It pays a decent dividend as well, and the valuation is pretty attractive. The thing about Russell that we like is that it's been around a very, very long time, and it's seen multiple recessions and multiple problems. They cut their dividend 20 years ago, and they kind of never forgave themselves for that because of the way the stock reacted.
I've got the dividend over 4%. Does that sound right?
Yeah.
Okay.
But they also don't take on a lot of material risk. It's just a refabricator. So steel prices are not really a big thing for them because they turn over their inventory so quickly. And that's where the company is actually really, really successful, is they don't take on that risk and they just turn it around. So steel prices go up and down, the economy goes up and down. As long as they manage their inventory, then they don't have a lot of capital at risk and they don't have a lot of exposure. So it's a very well-run, kind of quiet company that kind of falls under the radar. And so in a recession, of course, they're going to get hit. It is an economically sensitive stock, but it's also one where cash flow is improving, the balance sheet's improved, the valuation's great, the dividend's very, very solid, and it's just a sleeper name. It's not going to be exciting. You're not going to get a double, but it's not it's a nice little industrial company that's not followed very well.
Steel import export at this point, I mean, dramatically dropped, I imagine, what's going across the border and unlikely to change. So will that be a continuous drag for them?
Yeah, I mean, until you get the tariff situation kind of really resolved, it's not necessarily, super negative. It's the uncertainty of no one really knows how it's going to end up. So once you get that certainty on the table, it'll be better. But the Build Canada situation will help. They've got a very good Canadian business. They have the ability to go elsewhere as well, and they have the ability to make acquisitions. So, this is why it might be quiet, because people are like, I don't know what's going to happen next year, basically, is the problem. But as I said, they've seen it all before. They survived COVID, they survived 08.
Weather the storms.
Everything, yeah.
Okay, let's go to Gregory from Kamloops, BC. Gregory, what's your question today?
Hello, Peter. What are your thoughts on Rogers Sugar, which has a healthy dividend yield of 5.67%? Thanks.
Sure. Evaluation's okay, the dividend's okay, the balance sheet's okay. It's just a really boring company, and frankly, it's just not exciting enough for us. But if you're a mid-cap, small-cap dividend income player, it's a pretty good steady name. It's a consumer name. It's less sensitive to the economy. They are protected somewhat by sugar quotas, and you never really know what the government's going to do, but looks pretty secure right now with the trade wars going on.
How big are they in that space?
They're, I think, the number 2 player.
Okay.
And, it's a very hard market to get into because of the quotas and things like that. Many years ago, I'm dating myself again, they paid a special dividend in addition to the regular dividend. So it's a nice little small cap income stock. Just don't expect miracles here. Just
park your money, take your dividend.
Take your 5%, get the dividend tax credit, and be happy with that.
All right. Let's move on to another caller. Jim is calling from Peace River in Alberta. Hi, Jim.
Hi, how are you doing?
Good, how are you?
Good, thanks. I was wondering about Baytex. I retired a couple of years ago, and the fields up here in Peace River, Baytex is doing fantastic. How come their share price isn't doing anything?
Okay.
Sure, it's a tricky one because this used to be a $60 stock. And as you can see, it's not $60 anymore. They had a lot of screw-ups. They did cancel their dividends for multiple years. They had a really hard time sort of meeting expectations, and the stock just kind of fell off a cliff back in prior cycles. It's looking much better now. One of their issues was debt. They had a lot of debt, and especially in 2020, when it looked like oil was going to zero and it went negative, it was a big problem. They've improved the balance sheet. They've restarted the dividend. But you still have that legacy sentiment. As I was saying, we don't invest in Canada, but it was one of the stocks I hated the most in terms of when I was a manager at Sprott. But everything's changed now. It looks better. But you have to get over that sentiment. You have to get new investors looking at it with fresh eyes.
It's a stigma.
Exactly.
It is a stigma.
Exactly.
Okay, yeah, down to 329 is where we're
I
looking.
really think, just like Meg Energy, I think it should get taken over because someone could buy this company at a very big premium and still make it work for them. But I would have said that last year and the year before as well.
It's been dragging for a while. All right. Another quick break for us. We're going to take a look at past picks for Peter in a moment. Having a look now at past picks from Peter from March 27th of this year. At the time, Peter, you chose a Sport Radar on the NASDAQ at $22.50 US. It's up to $30.04 today, 34% upside for return and total return. And they do sort of data and tech for sports, and they're based out of Switzerland.
Yes.
So do they do sports data for like international players? What are they market specific?
Yeah, so there's a lot of gambling going on in the world, and so they've sort of tied themselves into data for gamblers, but also for the media that serves these gamblers as well. So it's very much tied to that market. But they do things like they give you special videos on individual players, and you can sort of track individual players and see how they're doing in different games. They do data analytics, so the bookies or the guys that are making the odds, they can have a better control over what the odds are to sort of protect their own business. The gamblers like it because they get far more information and they think that gives them an edge.
Inside scoop.
Exactly. Yeah. And the customers like it because they get far more information, which makes sure their edge is not disappearing. So it's they're kind of playing both sides. But it's a very interesting company. We're very pleased at how it's working out. And it's still relatively unknown. And their business in the U.S. is growing. And of course, the U.S. sports business is just absolutely booming. So I think there's still plenty of opportunity here.
Okay, so Sports Radar was their first pick for March. Second was Eagle Materials, again, March 27, 2025. This was 225, excuse me, 82, now to 234.68 US, so 4% return, 4% total return as well. And they do home building materials, essentially cement and other things, based out of Dallas.
Yeah. So they basically just anything you see in a dump truck, that's their business, like gravel, aggregate, asphalt. So anything in terms of building, not specifically only for homes, but for roads, construction projects, things like that. So it's kind of a infrastructure play. We like the valuation. They had made an acquisition, which looks pretty good over time, but it's just a very well-run company that's been through cycles. They've been through recessions. They know how to manage their business. Interest rates should help them. Infrastructure spending should help them.
How big of a player are they?
It's pretty big. I actually don't have the market cap off the top of my head, but it's a player that big enough to count, but not big enough to not grow. So there is potential there, certainly.
Okay, so let me just see if I could find the market cap quickly, and we can talk about, you would keep your money in this one?
Yeah, absolutely. So it's the whole theme about nice growth at the right valuation and with the right potential with a change in interest rates and future confidence coming to the economy.
Okay. I'm just very slow on this, obviously, so maybe I'll bring that back in a second. Market cap, no, I lied, 7.582.
Yeah, so it's
about right?
Yeah, absolutely. And then again, small enough to be acquired, small enough to grow, but not big enough where they can't grow.
Got it. Yeah. So either way, you're good. Yeah. Let's get to Genius Sports, which was your last pick in March at $10.84 US up to $12.74, so 18% upside return and total return. And they also do sports data. Are they very different from Sport Radar?
They're in the same business. They have a little bit of a different focus in terms of some of their customers, but essentially they have the same drivers of their business, which are positive. It's a smaller company, so it could be a better acquisition target. These two companies could merge. I'd be quite happy with that. That would work out for me. But it's a situation where just different markets, different geographic markets, and different focus with a smaller company. So,
and they are out of the U.S.?
Yes.
Got it. All right. Those are the past picks for Peter. We are going to take a quick break to line up some more phone calls. Back in a moment. Welcome back. Let's go to Gordon. He's been holding on the line in Victoria, BC. Hi, Gordon.
Good morning. Propel Holdings. You've got a management team that has a great track record building the business and others. You've got a lot of insider ownership. They're growing top and bottom lines at a very rapid pace, and yet it's trading at 17 times lagging earnings. Is this an undervalued stock?
We believe so. So it's a situation where the industry, it's subprime lending. So the industry is never going to get a huge multiple because people just do not like the industry. There's regulations. The government has capped interest rates. It's seen as kind of a loan shark business, which has got a lot of people don't like that. But it's a legitimate business. It's a legal business. They're doing very, very well. But it's never going to get a super high multiple. The forward multiple is closer to 12 because they're growing very fast. They've raised the dividend, I think, 8 times in the past 3 years. I might have that 1 or 2 off, but absolutely a very good dividend growth rate. They're growing in the 40% range. Expectations for growth is going to continue. They've got very good control on credit and their customers. Their market share is expanding. Interest rates will help them because they were able to sort of capture the lag in terms of lower financing costs versus what they charge the customers. So a very, very solid company. But you're never going to get a 25 multiple on this. But the stock had done very well, and it kind of everything was perfect. And the business is actually still good, but investors sort of said, oh, it's not quite as sexy as AI, so we're just going to not buy it these days.
Everybody's running with AI. That's where they want to put their money these days.
Yeah, but absolutely fundamentally solid. We like it a lot.
Okay, Gordon, I hope that helps you as we go on to Herman from Montreal. Hi, Herman.
Yeah, hi, Peter. I've been a member since of 5. Question is on Constellation Software along with Lumini and Topicus. They've dropped recently because of the AI scare, and I was wondering if they are able to make purchases of AI companies so they start becoming loved again. Thank you.
Sure. Constellation has probably been the best stock in Canada for the past 20 years. And this year, everyone has basically had a complete freak out because it was down 1% or so. And they've only gone down once in their entire history, one calendar year. They've only declined once. So again, back to the AI situation you were talking about, is AI going to eat software? So everyone's concerned that Constellation and their subsidiaries are going to suffer from AI. But they're not sitting around sort of waiting for their business to be destroyed. And it's actually quite unusual because this company doesn't do conference calls. They don't really care about their analysts because their track record speaks for themselves. Next Wednesday, they're doing a conference call to address this issue. So it's going to address their challenges, but also their opportunities. So absolutely, they could make acquisitions. But the problem here is they like to make cheap acquisitions. They don't like to spend too much, and they have very tight criteria. But this is a company that has succeeded perfectly for more than 2 decades and has never issued a single share while their stock went from $100 to $5,000. And so I'm not going to rule them out. They know what they're doing. They know the business. AI is not a new thing for them. I mean, they've probably been looking at it for years and years and years. It has not yet impacted their business in any way. Yes, it might. And there is some uncertainties there, but the stock's cheaper now because of it. So.
All right, and there's some stay tuned there, right? What happens when they share their forward plan and how it involves? Just the fact that they're having that call, I find interesting.
It is interesting, and I don't think they would have it if they were going to have bad news. I mean, it's just they know what they're doing, and they may have a longer time frame to fix things than investors think they do. So it'll be very interesting.
All right, let's go back to the phone lines. Reg on the line today from Winnipeg. Hi, Reg.
Hi there. Thanks for taking my call. Peter, I phone in every once in a while to talk to analysts like yourself about Manulife Financial, just to give it some airtime because it doesn't get the airtime the banks do. The curious thing about Manulife, when you look at the trading history on Manulife, it's got a very weird trading pattern. On the TSX, for example, you watch it 3 out of 5 days, opens, goes straight down. Last 20 minutes of trading in the day goes straight down. The financials own probably 51% of the float of Manulife, and it seems in the ecosystem that's going on behind the scenes, in my opinion, it seems that the bank analysts, a little bit, they drag their feet on re-rating Manulife. It should be easily, when you look at Great West or Sun Life, which are much, much higher price-wise, Manulife easily should be in the same category price-wise as those. It is not. It is the biggest diversified insurer, has a bank versus the other insurance companies that don't. It doesn't get the proper rating, in my opinion.
What's your question, Reg?
My question is, why is it trading at $43 a share when it should easily be over $50? That's my question.
Okay, thank you for the question. So basically, he's looking at the banks and he's doing a comparable here with an insurance company. Mm-hmm. Can you compare those two?
People like to, but they are different businesses, and higher interest rates are better for insurance companies than they are for banks. So one possible reason, I mean, there could be a million reasons, but you can't really define or prove any of them. I mean, sentiment is what it is. But higher interest rates are better for insurance companies than banks, and with rates going down, there might be some investors saying, you know what, that's not as positive an environment for insurance companies, so why do I need Manulife for? Then they could have legacy issues. This is a company that had to cut their dividend when other companies didn't have to. Again, dating myself, this was 15 years ago. It's a kind of a boring company.
And is it also understanding, like, if you're looking for a stock to invest in, I kind of get what the bank does. With insurance, I don't feel like it's as clear sometimes because they've got their hands in so many different things.
Exactly. And everyone thinks of insurance as, oh, the next hurricane's going to destroy their earnings, but they're not even involved in catastrophe insurance. So it's a bit misunderstood. That's reflected in the valuation. But it's done a very good recovery job. They raised their dividend, and they're raising their dividend faster than some of the other companies. So it may just be, sentiment, or maybe a couple of investors that are just exiting for whatever reason to go into more exciting fields. Without a definitive news release, you'll never know. But it's a solid company, and it's a solid financial company with a good dividend. I mean, there's nothing really wrong with that.
All right, let's go to Mike, who is on the line in Vancouver with a question. Hi, Mike.
Hi, Miranda. First-time caller. Just want to start by saying you're doing a great job. And Peter, I just wanted to ask with the interest rates starting to fall, Canadian REITs are going to be starting to come more into favor. Would you agree? And if so, could I get your thoughts specifically on Northwest Healthcare properties? Thanks for taking my call.
Sure. It's relatively small, but their business is relatively stable, focusing on doctors, dentists, anything in the healthcare field. So they had some issues, I think about 2 years ago, in terms of one of their clients, and they were losing some of their lease properties, and they cut their distribution. And it was one of those situations where it's a relatively small company that had cut their distribution, and of course, investors punished the stock mercilessly for months and months and months and months. They fixed that. Things are back on track. It's a nice little small cap, stable income company. Again, like some of the others we've talked to, you're not going to get rich off this, but you're going to get a nice stable dividend in a nice stable environment with a company that has had problems before and now seems to be fixing them.
Okay, we do have to take a quick break. We're going to come back to phone calls and emails for Peter Hodson of I2I Capital Management in just a moment. Welcome back. Ghulam is on the line in Toronto with a question today for Peter. Hi, Ghulam.
Oh, good afternoon to you both. My question is on a dividend-paying stock. I've got a GIC that's coming up for renewal, and they're paying some ridiculous rates of under 3%. I was thinking of putting some money into two dividend stocks. One is Telus, and the other one is Freehold Royalties. With the higher dividend at almost 7% and the dividend tax credit. Do you think it's a good strategy? And which one would you prefer of the two stocks? Or should I just split my investment into those two? Appreciate your thank you.
Okay, thank you for the question.
Let's focus on Telus, just because Freehold is commodity-based, and it's going to be a volatile stock depending on what commodities do. Maybe good, maybe bad. It's not a bad company, but a completely different story. So Telus, how do I appraise this? Say you're at a dog show and they're all ugly, but there's one that's less ugly. That's Telus. So unfortunately, they've had their issues. They're spending a lot of money on their network, but it's better than the other alternatives. They've raised their dividend. They raised their dividend not that long ago, a couple of months, whereas BCE, of course, has cut. Rogers hasn't raised their dividend in who knows how long, like years and years and years and years and years. So the dividend's nice. It's growing. It's relatively secure. It's a stable business with stable cash flow. The valuation's attractive. There's nothing really wrong with it, but the whole sector is not
beaten down.
Beaten down, and everybody's got to spend money on their network. And remember, we're still in a kind of a protective environment. Like if the Canadian government ever says, foreign competition, come on in, all these companies are going to be in a bit of trouble because they've been protected by the government in terms of the ownership rules and things like that. So not a bad income stock. Again, I can't say it's better than a GIC because a GIC is fully guaranteed, so it's a completely different ballgame. But
less ugly dog.
Exactly, that's the summary.
in the race. Okay, BCE, of course, parent company of Bell Media, which owns this channel, just for information's sake. Let's go to Dave. He's in St. John's, Newfoundland, with a question. Hi, Dave.
Hi, Peter.
Hi.
My question is on quantum computing. I know they're losing money, but is it too early to get into the industry, and in particular D-Wave, QBTS? Thanks very much.
Okay, so they do hardware more than software?
Yeah.
Okay.
And so if I was on last week, I would have said it's too early, but then all the stocks have gone up 50%, so what do I know? D-Wave doesn't have a lot of revenue, and it's all about whether quantum is going to be the next big thing. And so that's really not the type of stock that we like to look at, because it's basically a sentiment call and a call on the future. And also from a technology point of view, we're not experts in technology, but if we see sales, contracts, revenues, profit, that's a third-party confirmation that they're doing something. And the revenue base is just so tiny versus the market cap. So IONQ is a bigger company that's actually won some contracts this week. And so
INQ.
IONQ is that.
IONQ, thank you.
And it's just, I think it's just too risky. I think it's too early, and we haven't seen a market correction of any substance. And some of these companies that are trading at billions and billions of dollars market cap with essentially no revenue could get hit very, very hard if the market changes. So right now, everybody loves everything. The market's going up. It's not always going to be the case, and I'd really like to see them get some cash flow and revenue before getting on this one.
Okay, let's go to Derek on the line in New Brunswick. Hi, Derek.
Yes, I just wanted Peter's opinion on OpenText as far as their future and how it would be affected with AI.
Okay, thank you for the question. OpenText, also interesting, they just changed their CEO position, and stock has actually been moving up over the past number of months. But what does it look like for them moving forward?
Yeah, so again, it's the same sort of issue in terms of the software and the AI threat or opportunity. You are not going to know the answer to that for some time. The valuation has been horrible the versus relative tech peers, and it's kind of a hodgepodge of different software businesses, and they've had execution problems, and they've also had a lot of debt. So when a new investor is looking at OpenText, it's like, okay, you're cheap, but you have a lot of debt, and you're not really executing this well, and there's been management changes. There's not a whole lot of reasons to get too excited. And then we're very big fans of momentum, and their momentum is very negative most of the time. And if I was on 10 years ago, I would have said OpenText needs to be acquired. They've got a low multiple, nobody cares. Someone else can come over and fix this company. But that was 10 years ago, and I would say the same thing right now. Someone should buy these guys at the current valuation and change things and fix things. That doesn't mean you're even going to get a premium, because it's one of those situations where I think shareholders would say, you know what, I've had it with these guys. 10% premium's good enough for me. Let's move on. But so it's not our favorite. We kind of got trapped on this one on a value trap a little bit, because the valuation was attractive. It was a tech company. It was growing, but it's been kind of disappointing.
Okay. Let's try to get to Debbie before we have to take a break. Debbie's calling from Burnaby, BC. Hi, Debbie.
Hi, I'm just inquiring. I don't have any copper stocks I'm looking to buy. I'm looking at First Quantum, or if you could suggest any other Canadian copper stocks, I'd appreciate it.
Sure.
I will hang up and listen.
Thank you.
So First Quantum, it really depends on what an investor wants. So First Quantum's got huge leverage to copper through giant mines. Absolutely, if copper's going to go, First Quantum's going to go. But of course, the leverage works both ways, and if copper's not going to go, and it's not going to do
Trump applies tariffs.
Exactly,
and
then you've got the situation in Panama where they had a giant mine that was basically suspended by the government, and we don't know how that's going to be resolved. Again, if it's resolved, everybody's happy and everybody's great, and the stock's going to do very well. So I would prefer London mining. So even though it's operated by Swedish management, it's Canadian operations, Canadian listed, Canadian company, great balance sheet, good leverage, but not crazy leverage. And so if copper's going to go, that's the one I think that you want to own. If copper's not going to go, that's the one you want to own, because you don't want the leverage when things go the other way.
The same kind of risk. Okay, we will leave it there with phone calls and emails today, but stay tuned, because Peter's going to share his new top picks in just a moment. Join us Monday on Market Call. Brendan Caldwell on the show. He's president and CEO of Caldwell Investment Management. He'll take your questions on North American large caps. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for new top picks from Peter. And we're going to start with Nebius Group on the NASDAQ. This company has an interesting backstory. It's basically an AI data center build-out company.
Yeah. So the interesting part is this used to be run by Russian executives. And they were basically a combination of Google and Amazon in Russia. Very, very successful. The war came along. They denounced the war. they became enemies of Putin. So they're like, okay, we're out of here.
We're leaving.
So they go to the Netherlands and they sell off all the Russian assets and they basically restart from ground zero, doing what they did before. So I love that situation because management team has something to prove, basically, to Russia. They've started slowly and they've gone into the AI data center market, and they've got 4 or 5 other divisions, but it's been really, the stock's moving because of AI right now. So they're very experienced in data centers and managing customer expectations and growing these things. So then they won a $19.5 billion contract from Microsoft last week. And that's going to take some capital. So they raised $4.5 billion as well in tandem. So the market cap has gone from $2 or $3 billion to $20 billion in the past 2 years. And it really only started in early 2024. But here's where it gets interesting. The revenue base, according to Goldman Sachs, which just came out with a new research report, is going to go up 26-fold by the end of 2026. And if that succeeds...
Just based on their plan to build out data centers.
Yeah, and the new contract from Microsoft. And so if you take a look at that, they could have $4 billion in an annual run rate by the end of next year. And some of these companies in the space are trading at 15, 20 times revenue. And at $4 billion, they're trading at about 5 times revenue. It's actually quite an unknown company. When we first bought it about a year ago or so, the brokers wouldn't let us buy it because they thought it was still restricted because of the Russian sanctions. And we're like, no, it's a new company, you got to buy it. So it's a really interesting story. They're all cashed up. They've got the big contract. If they were to get another contract, and this company is very aggressive in terms of what they expect, the stock could really, really do well. So we're pretty excited about its potential. There's lots of risk. AI could slow. They couldn't get it. They might not get another contract. This contract has to be profitable. We're not that worried about that because it kind of finances themselves as they grow it. So Microsoft gives them a year of business, and then they kind of build out as they go along. So that's not a big worry, but it's not a slam dunk. But in terms of an unknown company coming out of nowhere, raising money, it's very interesting to us right now.
Okay, one to watch. Let's go to your next topic, which is e.l.f. Beauty on the New York Stock Exchange, which is a lower-end beauty product supplier. But you mentioned they are going to be in Sephora, maybe on a test.
Yes.
A test practice run?
Yeah, so they bought Rhode, which was Hailey Bieber's company, for $1 billion. And it was quite a good acquisition because it kind of changes their brand a little bit. But it's still going to be a lower price point. But here's where it does get interesting. So their growth is quite good. Their valuation's a little bit up there, but in terms of expectations, they could do very, very well. But their average price point is $6.50, and they plan to raise that $1. So as a consumer, you're like, oh, whatever, it's $1. But it's almost 15.5% in terms of what they can do from prices. And here we have a very, very, it's quite a substantially large company, and they said that their tariff impact is only going to be $50 million. So on an $8 billion company, that's nothing. And so investors are kind of re-examining it. It took a very big hit on tariffs because there are a lot of their manufacturers in China. But if there's any change in tariffs or if that price increase sticks, it's almost a non-event in terms of what they could do. And with new branding and new products and new initiatives, they're going after millennials and Gen Zs. The opportunity set is really quite good. They could have 30, 40, 50% growth over the next couple of years, and I think that will get noticed. I mean, it's still, even though it's the size it is, it's still relatively small, and a lot of people say, oh, whatever, I'll buy the big players. But they could become a $20 billion company, and then people say, hey, where'd they come from?
And are they only distribution is only across North America, or are
they have international business as well, but right now it's focused on North America.
Okay, that's their core area. All right, let's get to your next pick. Seco, is it Seco Environmental on the NASDAQ? And they're an industrial equipment manufacturer. What are you thinking for them?
Yeah, so think of sort of basic industrial things like they do water filtration, water management, dust control, sort of anything that's kind of in a factory, in a plant that helps them be more efficient. And so this is, a nice solid company. It's relatively small. It's under $2 billion market cap. But a lot of things we like about it right now. So in the last quarter, their sales grew by 35%, but their backlog and their orders grew by 95%. So the future revenue visibility is really quite substantial. It's relatively small, relatively unknown, but they're starting to become very, very profitable. So what they've sort of keyed in on, they also have an electrification management business. And so the easiest way to explain it is dust control. So if you're in a factory or a GPU factory or a data center factory, you have to have very, very clean air. So this is becoming a very big part of their business, and this is getting investors more excited. But still, it's only 32 times earnings, And that's that revenue visibility that looks pretty good. They've made some good acquisitions. And it's one of those ones where the stock has done well. It's up 60 or 70% this year. But if you can get that 95% order growth translating into an acceleration of earnings, going from 35 to 50, then that will get noticed. And it's quite an interesting name.
So if they did desk control previously, it was mostly sort of warehouses, industrial kind of thing, but now the data center adds that.
Exactly. So now it's basically demand has accelerated. So it's the same business, but more customers are saying, hey, we need your stuff.
It's amazing the amount of business that is going to feed off AI.
Well, when these companies are spending $80 billion annually, it does get spread around quite a lot.
Got it. All right, Peter, thanks for joining us. Thanks for coming in.
Thank you.
Good to see you. Have a good weekend. And that does it for Market Call for the day. Thanks for watching. We'll see you back here on Monday.